Today I'm going to hold my presentation about a topic from an article of The Economist at the beginning of November. The topic I'm talking about is climate change and investing, the uses and abuses of green finance, and raises the question if the financial industry can save the world. At this slide you can see the structure of my presentation. I will start by a short summary of the UN Climate Change Conference in Glasgow, after which it should be clear why we need a green shift in the economy. After that, I will go into detail about what green finance actually is and will present one of the most important green finance products, the green bonds. When talking about the role of the financial industry in climate issues, we can see that the reality of green investing differs a lot from the ideal world. After talking about the race to net zero and greenwashing, I will speak about the role of green central banking and afterwards discuss if the financial industry can save the world. Finally, I will sum up what needs to be done in order to tackle the current climate crisis out of the finance industry. This year, the UN Climate Change Conference took place from October 31st to 12th November in Glasgow, Scotland. Climate change is the biggest environmental threat, which is why the aim of the Climate Change Conference was to initiate effective climate protection, especially to keep the 1.5-degree target of the Paris Agreement within reach. Fossil fuels still dominate energy investments, and sadly, several developing and developed economies are still following pro-coal energy policies. Before the summit, there was the hope that emerging markets, which emit a large part of the world's greenhouse gases, would announce ambitious proposals. The host, Great Britain, even mentioned it would be the COP that kills coal. And for the first time at a COP conference, there was a plan to reduce the use of coal, which is responsible for 40% of the annual CO2 emissions. But sadly, the COP26 and its outcomes were disappointing. Support for fossil fuels across 81 major economies has been declining in recent years, but was still more than $350 billion in 2020. The plans of big economies like China, India, and Brazil all underwhelmed, and many world leaders have still not agreed to stop subsidizing fossil fuels. China and India have been increasing investment in renewable energy, but they remain amongst the world's largest public financiers of fossil fuels, spending tens of billions of dollars every year by subsidizing both their production and consumption. Fossil fuel subsidies are measures taken by governments that artificially lower the price of coal, oil, or natural gas. These take two forms. On the one hand, there are production subsidies, which are tax breaks or direct payments that reduce the cost of producing fossil fuels. And then there are also consumption subsidies, in form of energy price cuts for consumers, such as setting fixed prices at petrol stations. About three-quarters of the world subsidies are estimated to be focused on consumers, and a quarter on producers. Consumption subsidies are often seen in lower-income countries, largely to help alleviate poverty through measures that lower the cost of transport or the cost of cooking gas. Iran, followed by China and India, topped the list of consumption subsidies for 2019. All of them subsidize petrol prices. At this COP, the world leaders agreed to phase out inefficient subsidies, which encourage wasteful consumption. However, no firm dates have been set. In the Paris Agreement, the goal is defined to make finance flows consistent with a pathway towards low greenhouse gas emissions and climate-resilient development. This requires strategies to shift the economy from fossil fuels to clean sources of energy. Here, the green financing comes into play. Green finance is a type of future-oriented finance that simultaneously pursues the development of financial industry, improvement of the environment, and economic growth. It should incorporate new technologies, financial products, industries, and services that consider environment, energy efficiency, and reduction of polluted emissions to support low-carbon green growth. Basically, it is the ecologization of the financial system. Finance is the engine of development in infrastructure projects, including energy projects. Generally, financial institutions show more interest in fossil fuel projects rather than in green projects, mainly due to risks associated with these new technologies and their relatively lower rate of return. If sustainable development goals want to be achieved, we need to scale up the financing of investments that provide environmental benefits through financial instruments and new policies, such as green bonds, green banks, carbon market instruments, fiscal policy, green central banking, etc. These instruments are known as green finance. Examples of concrete green finance products are loans for solar panels on the roof of a house, bonds in a complete wind farm, or the investment in eco funds. Now I want to present one of those green finance products, the green bonds. They can be considered the most important innovation in the sector of green finance. Green bonds were created to fund projects that have positive environmental and/or climate benefits. The majority of the green bonds issued are green use of proceeds or asset-linked bonds. Green bonds are used by issuers to finance specific projects targeted at creating positive environmental impact. Projects typically relate to sectors such as renewable energy, sustainable management of natural resources, pollution control, and prevention. The largest buyers of green bonds are institutional investors. The green bond market has seen exponential growth. It reached its most sustainable milestone yet, with $1 trillion in cumulative issuance since market inception in 2007. Issuing green bonds can become an important financial mechanism to support a green economic recovery, because they are aligned with the objective of curbing the climate crisis and can further boost struggling domestic economies through investments in the renewable energy market. It is one of the most readily accessible and economical options to help raise large amounts of capital for infrastructure development to meet environmental targets. Here you can see the development of the green bonds market between 2014 and 2020. As you can see, Europe leads the growth in green bonds in 2020 with around $140 billion. Here is a little video that gives you an overview on green bonds and their functions. You can either watch the video here on the PowerPoint or with the link below. What is crucial is that the financial industry has a huge role to play in climate issues. A vast reallocation of capital is needed to shift the economy from fossil fuels to clean sources of energy. By 2030, around $4 trillion of investment in clean energy will be needed each year, which is 3 times as much as the current level. In an ideal situation, fossil fuel spending would decline. The profit incentives of institutional investors would be focused on reducing emissions, and these financiers would control the global assets that produce emissions. asset owners would have both the incentive and the resources to reinvent the economy. But sadly, the reality of green investing looks different and puts some obstacles in the way. There are three major problems which green investing has to face: coverage, measurement, and incentives. It is estimated that listed companies that are not state-controlled account for only 14 to 32% of global emissions. State-controlled companies, like the oil producers Coal India or Saudi Aramco, are a big part of the problem, and they are not under the influence of institutional fund managers and private bankers. In addition, there is still no way to accurately assess a portfolio's carbon footprint without double counting. For this reason, emissions from a barrel of oil could appear in the carbon accounts of the companies that drill, refine, and burn the oil. Another question is how shareholders, lenders, and insurers would allocate emissions from coal-fired power plants. In general, methods for allocating emissions to financial flows are still very vague. Even though there is an increasing risk arising from high carbon and climate vulnerable infrastructure choices, private financial firms still aim to maximize risk-adjusted profits for their clients and owners, which is not well aligned with cutting carbon. The Economist article states that the simplest solution to reducing the carbon footprint of a diversified portfolio would be to sell the portion invested in dirty assets and invest the proceeds in companies that never emitted much, like for example, Facebook. While Facebook's energy consumption increased significantly by 146% between 2011 and 2015, the company now announced that it has reached net zero emissions and is aiming to achieve net zero across its entire supply chain by 2030. Facebook said it reduced its greenhouse gas emissions by 94% over the past 3 years, and its operations are now supported by 100% renewable energy. Facebook's data centers are cooled using less water and less electricity than traditional air conditioning units. But the company is not yet powering its entire business with renewables. Instead, it can buy renewable energy certificates to match fossil-generated power. So if a company is pursuing a net zero goal, they don't automatically power everything with renewables. Climate activists reacted to Facebook's announcement that the biggest source of emissions from social platforms is not their data centers, it's their advertising and content policies. The 5 biggest American tech firms have a carbon intensity, emissions per unit of sales, of about 3% of the S&P 500 average. S&P 500 is a stock index comprising the shares of 500 of the largest publicly traded US companies. The race to net zero has become a point of positive competition for some of the world's largest tech companies. Facebook, Google, Microsoft, Apple, and Amazon all have different ambitious goals for cutting their climate emissions. In September, for instance, Google announced that it had not only reached carbon neutrality, but offset all carbon it had ever produced. The problem with this new trend and race towards net zero is the increasing risk of greenwashing, which arises along with the development of green finance. Corporations and private actors can use deceptive marketing strategies to promote their products and build an environmentally friendly image without an actual effort to produce completely green. Greenwashing can take many forms. For example, by changing the name of the product to induce perception that it comes from a natural environment when it does not. Like you can see at the marketing of these razors with slogans like Ecolutions, bioplastic, and so on. Greenwashing also happens a lot when firms launch marketing campaigns conducted by polluting industries to foster a green image. The lack of universal definitions and standards amplifies the risk of greenwashing as it opens room for interpretation of what green means in the financial sector. Since central banks are a key component of our financial industry, it is interesting to look at their role in the climate crisis. Green central banking takes account of environmental risks, including risks from climate change, which may have a material impact on the short and long-term stability and development of the financial sector and the macroeconomy. First, I want to outline which role central banks play in climate issues. Within the central banks, there lies a huge responsibility for financial and macroeconomic stability, which therefore ought to address climate-related and other environmental risks on a systemic level. Central banks are also in a powerful position to support the development of green finance models and enforce an adequate pricing of environmental and carbon risk by financial institutions. Especially in developing countries, they typically have a strong institutional standing that enables them to shape policy outcomes in ways that other public institutions, such as environmental ministries, are unlikely to achieve. Investment will have to be directed away from carbon and resource-intensive investments towards sustainable investments. Central banks and regulators are making it easy to identify climate-related risks through uniform definitions and comparable standards. In some countries, regulators already require financial institutions to have clear reporting requirements or sustainable investments. But there is a reciprocal influence between climate change and central banks, since climate change has also a huge impact on central banks. The consequences of climate change increase the risks to price and financial market stability. To state an example, climate change may have a significant impact on agricultural production, both domestic and abroad, and hence in food prices, which are an important part of consumer price inflation. Droughts and floods could also cause supply shocks, rising prices and cost push inflation. This would have an impact on aggregate income and employment, especially in countries where agriculture is a central pillar of the economy. There are three different types of risks through which climate change may affect the financial system. First of all, there is a transitional risk, which describes the uncertainty associated with policy, price, and valuation changes that may occur in the process of mitigating climate change. Furthermore, we can identify a physical risk, which is the risk of natural hazards, such as floods and storms, which may cause direct damages to an economy as well as indirectly through the disruption of global supply chains. It is already difficult to refinance insurance against crop losses due to extreme weather or damage caused by environmental catastrophes. And finally, there is also a liability risk, which describes climate or environmental risks that occur from uncertainty surrounding potential financial losses and compensation claims stemming from damages caused by climate-related natural hazards. Climate change-related natural disasters can create and intensify risks to stability of the financial system, and potential disruptions from climate change should be taken into account by central banks, since they are responsible for safeguarding financial stability. The big question of the article, if the financial industry can really save the world, sadly needs to be answered with no. The problem is that it can be profitable to hold assets that can legally generate untaxed externalities, in this case pollution, until negative externalities are priced appropriately. Furthermore, heavily polluting firms or assets will often find new owners, even if some companies sell their dirty assets. Even though shareholders urge oil majors to clean up, the oil fields they sell are being bought by private equity firms and hedge funds away from the public eye. Pledges alone do not alter the fact that firms have little reason to invest trillions in green technologies that still have mediocre risk-adjusted returns. But in order to end this presentation on a more positive and optimistic way, I want to present some measurements that can actually help fighting the negative impact of the financial industry on climate change issues. In the year 2006, Nicholas Stern projected that without proactive actions to mitigate greenhouse gases and adapt to climate change, it will cost us more than 5% of gross domestic product, and within 20 years the global economy could shrink by 5 to 20%. But with a proper response, the cost involved with mitigation actions can be confined to 1% of the total GDP, which means that according to Stern, early actions to mitigate greenhouse gases can make a big difference. In general, there are basic actions that need to be addressed, like the improvement of the measurement of a portfolio's carbon footprint or a mandatory carbon reporting for businesses. Also, the article states that instead of selling all the dirty assets in order to get a Wild West, asset owners should hold on to their investments in polluting firms and use them to help bring about change by linking the assets to requirements. Furthermore, institutional investors need to build up their venture capital arms to finance new technologies. We need a green growth policy which focuses on how economic development can be achieved by reducing carbon emissions. Achieving the goals of the Paris Agreement requires greening financial markets and building green finance ecosystems. Green growth financing mechanisms can be establishing or revamping green or environmental funds and other market-based mechanisms, ensuring stimulus investments focus on the green economy, implementing green fiscal reforms and redirecting existing funding, or greening the financial sector and developing green segments. Other instruments are cap and trade systems, which are internalizing mechanisms for greenhouse gas emissions that set maximum levels of emissions and provide incentives to remain below those levels through a trading system. The necessary environmental legislation will also lead to asset losses on investments in energy-intensive industries. Green fiscal reforms, if designed well, can be a valuable instrument for a medium to long-term rationalization of inefficient expenditures, such as environmentally harmful subsidies and the alignment of domestic budget processes with national development plans aimed at achieving sustainable and inclusive growth. An example for a green finance mechanism is South Africa, which also has a carbon tax and provided subsidies for the rollout of 1 million solar water heaters in an effort to reduce greenhouse gas emissions from the use of coal-powered electricity. Furthermore, we need massive investments in green energy systems and an end to the construction of new coal-fired power plants. Financial investments need to follow into sustainable development projects and initiatives, environmental products, and policies that encourage the development of a more sustainable economy. Also, there needs to be a standardization by accounting bodies on how climate measures are disclosed. And finally, it would be target-oriented to set a worldwide carbon price. This would target all firms and not just those controlled by some institutional investors. The urge to avoid the tax would supercharge efforts to account emissions. Furthermore, firms and governments would have incentives to grapple with questions of who is polluting and who should pay. A carbon price would align the profit incentive with the goal of reducing greenhouse gases. Here, the job of the financial system would be to amplify the signal sent by the price of carbon. This combination of measurements that can be integrated into the financial system would be a powerful engine for changing how economics work. On the last slide that you can see now, there is a little video about the COP in Glasgow this year, because since we began with the COP, I also wanted to end with a little video summing up the positive impacts the COP has had. And yeah, if you want to, you can watch it. I really like the video, and yes, I thank you very much for listening, and I hope you have a great week.